$5,000. For most people, that number sits in an uncomfortable middle ground. It feels too large to spend casually, yet strangely too small to feel powerful when it comes to investing. If you spend it, you probably feel a little guilty. If you invested it, you might wonder whether it even makes a difference. After all, when people talk about investing seriously, they often mention six figures, retirement accounts, or massive portfolios built over decades. In comparison, $5,000 can feel almost insignificant. But here's the reality. Most investors discover much later than they should. The size of your starting investment matters far less than the structure you build around it. Because a well-designed portfolio, given enough time, can transform an amount that feels small today into something surprisingly large in the future. And that's exactly what we're going to build in this video. We're going to take a one-time $5,000 investment and design a portfolio around it, not based on hype, not based on guessing the next winning stock, but based on a simple structure that gives each part of the portfolio a specific job. First, we'll walk through two decisions every investor should understand before investing a single dollar. Then we'll build the portfolio structure itself using three separate buckets, each responsible for a different role inside the system. And finally, we'll look at how this exact structure could potentially turn that original $5,000 into more than $350,000 over time if the market behaves anywhere close to its historical averages. But before we talk about funds, allocations, or projections, there's something far more important to get right. Because the investments themselves are not the most important part of this process, the decisions you make before investing the money determine how the entire portfolio will behave later. So before touching the $5,000, we need to answer two simple questions. The first question is deceptively simple. What job is this money supposed to do? Money can serve many different purposes, but when it comes to investing, it usually falls into one of three categories. The first job is growth. Growth means the goal is to make the money significantly larger over time. Most of the return comes from rising asset prices rather than income payments. These portfolios tend to move around a lot from year to year. Some years feel incredible, others feel uncomfortable. That volatility is part of the trade-off. Growth-focused investments sacrifice stability in exchange for stronger compounding over long periods. The second job is income. In this case, the goal is not maximizing the account balance as quickly as possible. Instead, the focus is on producing reliable cash flow, dividends, distributions, or interest that can be used as income. Income-focused portfolios usually feel more stable, but their long-term growth is often slower. The third job is flexibility. Flexible money isn't necessarily trying to grow quickly or produce income. Its purpose is optionality. Liquidity, the ability to act when opportunities appear. This type of money protects you and gives you choices, but by itself, it rarely compounds dramatically. None of these goals are wrong. The real problem happens when investors mix them together without realizing it. Trying to make the same dollar grow aggressively, produce income, and remain perfectly safe at the same time usually leads to disappointment. So for this portfolio, we need to make the decision deliberately. This $5,000 is not emergency money. It's not money needed next year. It's not money meant to generate monthly income. Time is the biggest advantage here. And when time is on your side, historically, growth has done the majority of the heavy lifting. But choosing growth brings us to the second question every investor needs to answer honestly. How much volatility can you actually tolerate? Because growth rarely feels comfortable in the moment. A 20% drop doesn't sound that dramatic when you hear it as a percentage. But attach that number to real money, and suddenly it feels very different. If you invest $5,000 and the market falls by 20%, you're watching $1,000 disappear from the account balance on paper. A 30% drop pushes that loss closer to $1,500. Those kinds of swings are not rare accidents in growth investing. They're normal parts of the journey. Markets move in cycles. Periods of strong expansion are often followed by corrections, slowdowns, or even full bear markets. And if a portfolio is designed for growth, it will inevitably experience those uncomfortable periods. This is where many strategies fail, not because the investments themselves were wrong, but because the investor wasn't prepared for the experience of holding them. When the account balance falls sharply, the temptation to sell becomes incredibly strong. And once someone exits the market during a downturn, they often miss the recovery that follows. That's why understanding your own tolerance for volatility matters before choosing any investments. Once those two decisions are clear, choosing growth and accepting the volatility that comes with it, the structure of the portfolio becomes much easier to design. Instead of chasing whatever performed best last year, you start asking a different question. What tools allow a growth portfolio to survive long enough for compounding to actually work? This is where the idea of 3 buckets comes in. Each bucket has a very specific role inside the portfolio. None of them is trying to do everything at once. The first bucket is the growth engine. This is where the majority of the long-term compounding comes from. It's the part of the portfolio that takes the most risk, but also has the potential to produce the strongest returns over time. In this strategy, that role is filled by VGT, the Vanguard Information Technology ETF. VGT focuses heavily on the technology sector, which has been one of the primary drivers of global economic growth over the past several decades. Inside this fund are companies responsible for much of the innovation shaping the modern economy. You'll find businesses like Apple, Microsoft, NVIDIA, and other major technology leaders that dominate software, semiconductors, cloud infrastructure, and digital services. Because these companies reinvest heavily into growth rather than distributing large dividends, VGT produces a very small dividend yield, typically around 0.4%, but that's not the reason investors choose it. The real appeal of this ETF is its price appreciation. Over long periods, technology companies have delivered some of the strongest growth in the entire market. Historically, VGT has averaged annual returns above 20%, although those returns have never arrived in a smooth line. There are years when technology stocks surge dramatically, and there are years when they fall just as quickly. This is the portion of the portfolio that will likely feel the most volatile. It's the engine that drives aggressive compounding, but it's also the part that demands patience during difficult market conditions. That volatility is not a flaw in the design. It's the price paid for asking the portfolio to grow aggressively over long periods of time.
But building a portfolio entirely around one sector would introduce another kind of risk, relying too heavily on a single market or economic trend.
Which is why the second bucket exists. Because growth does not happen in only one country, one industry, or one economic cycle. And the next piece of the portfolio helps protect against that kind of concentration. The second bucket in this portfolio is what I like to call the global backup. If the first bucket is the growth engine, this one is about diversification across the rest of the world, because no country dominates global markets forever. Over the past few decades, the United States has produced some of the strongest stock market performance anywhere. Technology companies in particular have driven enormous returns. But history shows that leadership rotates. There have been long stretches where international markets outperformed the U.S. and periods where emerging markets delivered stronger growth than developed economies. A portfolio that depends entirely on one country is quietly making a very large bet on that country continuing to lead forever. The global backup bucket helps reduce that risk. In this portfolio, that role is filled by VXUS, the Vanguard Total International Stock ETF. VXUS provides exposure to thousands of companies outside the United States. That includes major developed markets such as Europe, Japan, and the United Kingdom, along with rapidly growing emerging markets across Asia, Latin America, and other regions. Instead of concentrating on a single economy, VXUS spreads investment across a wide range of global businesses. Compared to U.S. technology, the growth here has historically been more moderate. International markets have typically delivered mid-single-digit price appreciation over long periods. That slower growth is not a weakness. It simply reflects different economic structures and growth patterns around the world. What VXUS adds to the portfolio is balance. When U.S. markets are dominating, international stocks may lag behind. But during certain global cycles, those same international markets can outperform. This diversification helps prevent the portfolio from being entirely dependent on a single market environment. VXUS also introduces something the growth bucket largely lacks: dividend income. International companies tend to distribute a larger portion of their profits to shareholders compared to many U.S. technology companies. As a result, VXUS currently carries a dividend yield closer to 3%, significantly higher than the yield from VGT. Dividend growth has also historically been stronger than many U.S. averages. That doesn't turn this into an income portfolio, but it does create a small stream of reinvested cash flow that compounds quietly over time. The job of this bucket isn't to beat the growth engine. It's to support the overall structure, smoothing the portfolio across different economic cycles while still participating in global growth. But even with international diversification, there's still one major weakness most growth portfolios share. They behave very similarly during periods of stress. When markets panic, investors tend to sell stocks across the board. And U.S. stocks, international stocks, large companies, small companies, everything drops together. And when that happens, portfolios built entirely on equities can become extremely uncomfortable to hold. That's where the third bucket comes in. This final piece of the portfolio exists for a very different reason. It's not designed to grow the fastest. It's designed to behave differently when everything else struggles. The third bucket in this portfolio is what I call the shock absorber. This is the piece most growth investors skip. And ironically, it's often the reason many portfolios fail, not because they lacked growth potential, but because they lacked something that behaved differently when markets became stressful. In this portfolio, the shock absorber is gold, accessed through the ETF GLD. Gold is very different from stocks. It doesn't produce earnings, it doesn't generate dividends, and it doesn't grow in the same way businesses do. Instead, its value comes from how it behaves when confidence in financial markets weakens. During periods of economic uncertainty, currency instability, or financial crises, investors often move toward assets that historically hold value during turmoil. Gold has played that role for centuries. Because of that, gold tends to move differently from stocks. While equities can fall sharply during market crashes, gold often rises or at least holds its value better during those same periods. Over extremely long time horizons, gold has still produced positive returns. But those returns usually appear in bursts rather than smooth, steady growth. There may be long periods where gold moves sideways, followed by sudden sharp increases during times of financial stress. Over the last decade, gold has delivered returns close to 16% annually. However, using that number for long-term projections would risk something called recency bias, assuming the most recent performance will continue forever. To remain conservative, a more reasonable long-term estimate places gold's expected return closer to 8% to 10% per year, which better reflects its historical performance over longer periods. But again, the goal of this bucket isn't maximizing returns. Its purpose is changing how the entire portfolio behaves during difficult market environments. When markets fall sharply, the presence of an asset that behaves differently can help stabilize the overall portfolio. And that stability has a psychological benefit as well. A portfolio that drops less during downturns becomes easier to hold, and staying invested during those difficult periods is often what allows compounding to continue working over time. When we combine these three buckets together, growth, global diversification, and protection, the structure becomes much more resilient. But structure alone isn't enough. The next step is deciding how to divide the $5,000 across these three roles, because the weights we assign determine how aggressive the portfolio truly becomes. If the growth bucket dominates, the portfolio becomes more volatile, but potentially more powerful. If the defensive bucket grows too large, stability increases, but long-term growth slows down. Finding the right balance is where the portfolio starts to take its final shape. And that's exactly what we'll build next. Now we arrive at the part people tend to focus on the most, the allocation. But the truth is, by the time you reach this step, most of the real thinking has already been done. The portfolio already has a clear purpose. The buckets already have defined roles. All that remains is deciding how much of the $5,000 goes into each one. In this structure, the largest portion goes to the growth engine. 50% of the portfolio goes into VGT. That means $2,500 is placed directly into the technology sector. This is the part responsible for aggressive compounding. It will likely produce the largest gains during strong market cycles, but it will also be the most volatile. Some years it may feel unstoppable. Other years it may fall sharply. But if this portfolio is going to grow meaningfully over decades, most of that growth has to originate here. The second bucket receives 30% of the portfolio, which equals $1,500 invested in VXUS. Again, the purpose of this portion is not to outperform U.S. technology. Its job is diversification. VXUS spreads the portfolio across thousands of companies outside the United States. It introduces different economic cycles, different currencies, and different industries that may grow under conditions where U.S. markets struggle. It also adds a slightly stronger dividend component to the portfolio. This bucket helps reduce the risk of tying the entire future of the portfolio to a single country or sector. The final 20% of the portfolio, $1,000, goes into GLD, the gold allocation. For many investors, this is the most debated piece of the portfolio. Gold does not produce income. It does not compound like stocks. And in strong bull markets, it may appear unnecessary. But this allocation is not about chasing returns. It exists to change the experience of holding the portfolio during difficult market environments. When stock markets fall sharply, gold has historically behaved differently enough to soften the overall decline. That difference can make it psychologically easier to stay invested during periods when many investors panic. And staying invested is what ultimately allows compounding to work. So once the allocations are complete, the portfolio looks like this. Half aggressive growth through technology, nearly one-third diversified across international markets, and a smaller portion dedicated to protection during market stress. Now, the final step is to step back and evaluate the portfolio as a whole rather than focusing on each asset individually. But when all three components are combined, the portfolio produces a dividend yield of just over 1%. That immediately tells us something important. This portfolio is not designed for income. If generating monthly cash flow were the goal, this would be the wrong strategy entirely. Dividend growth across the portfolio averages under 3%, which reinforces the same point. Income exists here, but it plays a very small role. The real engine behind this structure is price appreciation. Historically, the combined average growth across these assets has been a little over 15% annually. That number is what drives the long-term outcome. So what happens when we apply that growth rate to the $5,000 investment? After the first year, the portfolio is projected to grow to about $5,800. After 10 years, the value could reach roughly $21,600. At this point, the compounding effect begins to become visible. By year 20, the portfolio could grow to approximately $89,600. Time begins doing far more work than the original investment itself. And after 30 years, that same $5,000 could potentially reach $367,000. Now look at where that value actually comes from. Over those 3 decades, the total value added is projected to be around $362,000. Nearly all of that growth, roughly $360,000, comes from capital appreciation, the rising value of the assets themselves. Dividend reinvestment contributes only about $2,000. Even after 30 years, the annual dividend income from the portfolio would be about $78 per year, or roughly $6 per month. That might sound surprisingly small, but it simply reflects the strategy working exactly as intended. This portfolio was never built to generate income. It was built for long-term growth. And sometimes the most powerful portfolios are the ones that quietly compound in the background for decades. Because when time and compounding work together, even something that begins with just $5,000 can grow into something far larger than most people expect.